I know you're going to learn a lot watching this video. This is Chapter 6 of Accounting 201, Cash, Fraud, and Internal Control. I will review the highlighted learning objectives in this recorded lecture. First, we will look at internal control. Managers of small businesses often control the entire operation. They know whether the business is receiving the assets and services that they paid for. But most larger companies are not going to be able to personally observe everything, so they need to rely on internal controls. So managers will use an internal control system to monitor and control the business activities. An internal control system includes the policies and procedures that are used to protect the assets, ensure reliable accounting, uphold their company policies, and promote efficient operations. There are some limitations of internal control from both a human element and a cost-benefit principle. The human element limitations can be either human error, so they made a mistake, or fraud, which is an intentional defeating of the internal controls. And then we're looking at the triple threat of fraud, which includes opportunity, pressure, which could be from their family or society, and rationalization, which is where employees justify their behavior. The second related issue has to do with the cost-benefit principle, which says that the cost of the internal controls must not exceed their benefits. Next, we're going to look at internal controls to help with cash receipts and cash payments. So we have this new account called Cash Over and Short, and if we end up with more money in a cash register than we are supposed to have, we will have a cash over and short. So it will basically be like a revenue. So in this example, the cash register shows $550, but counting the cash, they have $555. So they have an overage of $5. In that case, we would prepare this journal entry to increase cash, $555, increase cash over and short, $5, and increase our revenue for the amount of the revenue, which is $550. So the cash over and short account is an income statement account, and it will record the cash overages and the cash shortages. On the other hand, if we have not enough money in our cash register, we would need to debit the cash over and short account. In this example, the cash register shows that we made sales of $625, but we only have $621 in the register. So we can only debit cash for the $621, debit cash over and short for the shortage, and credit our revenue for the full amount of $625. Next, we will look at petty cash funds. A petty cash system is used for our small payments such as shipping fees and low-cost supplies. So to avoid time and the cost of writing a check for small amounts, a company can set up a petty cash fund to make these small payments. This is the journal entry to establish a petty cash fund. These are both cash accounts, so we're debiting one type of cash account called petty cash and crediting our normal cash account. Next, we need to, at some point, look to see if we need to replenish our petty cash account. So first, we'll prepare this cash payments report, and you can see that we have receipts for $71.30. So we need to record these expenses. So you can see them here. This is merchandise inventory, delivery, office supplies expense, and miscellaneous. Here's the journal entry. So notice that we're crediting cash. We are not crediting petty cash. What we're going to do is take $71.30 out of the cash account and put it back into the petty cash box. And these are the accounts that will be debited. Now, if we want to increase or decrease the petty cash fund, that's when we will have to make a journal entry affecting petty cash. So here we're increasing it by $25, and here we're decreasing it by $20. Now we may have to use that cash over and short account in the petty cash fund if there is maybe someone forgot to put a receipt in or they paid out too much. So you still have to reconcile the receipts with the amount of cash you have left. So in this example, the fund had $200 in it, and we had receipts for $178. So the difference between 200 and 178 is the amount that we are short. So let's look at an example of where we need to use the cash over and short related to petty cash. We will credit cash for the amount that we need to bring it back up to its original balance. In this example, we had $200 and we have 15 left. So we have to credit cash for 185. We have receipts for only 178. So the difference between what we have receipts for and the amount we have to credit cash for will be either debited or credited to our cash over and short. In this example, we are short $7, so that means they forgot to put a receipt in for $7 or they paid out too much. So regardless, we have to reconcile this, and here we're going to debit cash over and short for the amount of the shortage. Let's look at the bank reconciliation. So usually once a month, the bank will send a bank statement. And what we need to do is look at the ending balance shown on the bank statement and reconcile that to the ending balance in our general ledger cash account. These are the items that we need to do adjustments for. So for the bank balance, we need to add deposits in transit. These are deposits that are made after the bank statement. We need to subtract outstanding checks, which are checks that have not cleared the bank yet, and then add or subtract if the bank made any errors. On the book side, we need to add interest that was earned, and we need to subtract any bank fees or non-sufficient funds checks, and then add or subtract any errors that we made. So these are the steps. So the bank statement balance started off at $2,050. We had one deposit in transit, so we'll add that. We had two outstanding checks, so that needs to be added together and then subtracted. So $21.95 minus $350 gives us our adjusted bank balance of $18.45. Then our record showed we had $14.05. The bank collected a note for us, so the customer sent the amount to the bank, and we saw it on the bank statement, and we're going to add interest. So that totals $493. Add that to the $1,405 to get $1,898, and then we need to subtract a check printing charge and a non-sufficient funds check from one of our customers. So add these two together, subtract 53 from 1898 to get our adjusted book balance, and these numbers must be equal. That means we are reconciled. Then we have to prepare adjusting entries for any item that we adjusted the book balance for. So we have a note and interest, and then we have the printing charge and the non-sufficient funds check. So we have to have a journal entry, a total of 4, to bring our balance from 1405 to 1845. These are the journal entries. So we had collection of a note, collection of interest, the check printing charge, and our non-sufficient funds check. We need to put it back in accounts receivable because they do owe us again. And the other half of each of these journal entries will be to the cash account. This concludes the recorded lecture for Chapter 6. I hope you learned a lot watching this video.